All right, well, we're just over 90 minutes into the trading day and we're seeing stocks and bonds still under pressure. Now, this comes as a speech from Fed Chair Powell sent the 10-year Treasury yield over 5% for the first time in 16 years. It's now hovering just under that, but with all this volatility in the market, our next guest has a few key themes that we can all keep our eyes on to help us navigate. Let's bring in Kristina Hooper, Invesco Chief Global Market Strategist. Good to have you, Kristina. So, obviously, investors trying to make sense of what they should focus on and what's actually moving markets. And you've laid out 6 key themes here. Talk about the ones that you've identified and why they're going to be the biggest market movers.
Well, first, I should say that one of the biggest market movers, of course, is the 10-year U.S. Treasury yield. But we have to recognize that what we're seeing happening right now is likely a very short-term phenomenon. So that even though it's putting very, very significant pressure on equities, and of course, bond prices are going down, it's unlikely that we see it at this level for much longer because it's all about the Fed. The Fed is still driving markets. And so as long as we don't have clarity on Fed policy going forward, which is a big theme, right? If the Fed is driving markets and we don't know when the Fed is going to stop hiking rates, and we certainly don't know when the Fed is going to start cutting rates, that's a real problem. But I suspect we're going to get clarity sooner rather than later, because really, if we think about what triggered the most recent run-up in the 10-year yield, it started with the release of the Fed's dot plot back in September. The June dot plot showed an implied 4 rate cuts in 2024. Fast forward to the September dot plot, and what we saw was just an implied 2 rate cuts. And that really got markets nervous because they read between the lines and between the dots and said higher for longer. But that may very well not be the case because at the end of the day, the Fed is data dependent. So again, that is really the key theme.
And something else that you noted, that markets are becoming somewhat desensitized to geopolitical risk. And it's interesting because when you think of some of the responses that we used to see anytime China came out with data, or what we saw with the Russia-Ukraine conflict, but then most recently with the Israel-Hamas conflict, didn't see the same extreme sort of market reaction. What do you attribute that to?
I just think markets have become very accustomed to this, whether it's the Speaker of the House and or are getting very close to a government shutdown. Markets have recognized that there's a level of resilience there, especially with the overall economy. And of course, keep in mind, the Fed's driving markets as well. So I think that creates a level of desensitization. But having said that, I do think there's a difference between that, which is perceived to be contained, versus that which is perceived to be contagious. And so, for example, last spring, when we had the mini regional banking crisis, markets came to the conclusion that it was contained, and so they were able to move on. And similarly, at the beginning of this Middle East conflict, I think markets assumed that it could be contained. Now we're seeing more jitters, more nervousness that it may be contagious, that other countries might join in. When we have days or periods like that, we're much more likely to see more pressure on markets. But having said all that, if we look at history, geopolitical risk tends not to have any significant impact beyond the very short term.
And of course, we have to talk about the US economy, still showing some resilience here. But what about the lag, some of the cracks that perhaps aren't still showing up in the data yet as they work their way through the economy?
Right. That's a great question, Rochelle, because there tends to be, the rule of thumb is 12 to 18 months lag between when policy is implemented and when it shows up in the economy. So if we think about it, the Fed rate hikes only started in March of 2022. So we certainly haven't seen all the impact that we're likely to see show up in the economy. And so the Fed really needs to look ahead and say, where are we going and what is going to happen? And I certainly think that the tightening of credit conditions we're seeing, that is going to continue, and that is going to certainly put downward pressure on the U.S. economy. Now, I do believe that the U.S. economy is strong enough with very low, sub 4% unemployment, a relatively strong consumer in general, although there are weak spots. I think the U.S. economy does not go into any kind of broad-based significant recession in this environment. But it's certainly a bumpy landing because we've had a really aggressive set of rate hikes in a very short period of time.
And I do want to ask you, of course, the tech bump that we've seen that has been, lifting the rest of the markets here. How short-lived is that going to be, though? Is that something that can continue this pace, especially as we're getting something of an inkling of how things are faring with earnings season?
Well, we have to recognize that technology stocks certainly are perhaps the most vulnerable sector when it comes to rising rates. Because they're perceived to be long duration stocks, they tend to be more sensitive when rates go up. But there is some positive news in the tech space. Fundamentals are strong, and I think that we're going to see a good earnings season from technology because they have cut costs. They've improved their margins, and so there will be countervailing forces there. But I do believe over the longer term, technology is attractive, and it will just have to weather short-term higher rates.
And of course, I do want to dig into China because originally, when we were coming out of the pandemic, you had the IMF, everyone saying China's going to be the country's economy that lifts the rest of global growth. That has not panned out. So how is that factoring into how the market is perceiving where we go from here?
Well, I think the market is rightly assessing that China is a mixed bag. There are certainly parts of the economy that are doing well, but of course, the property sector continues to be a problem. I think that going forward, what we're likely to see is targeted policies directed at the property sector. That not only will help alleviate pressure there, but should provide a boost to consumer and business confidence, which should be key to having a more robust recovery for the Chinese economy.
And in terms of what market watchers should be looking at here, what's going to be the next catalyst to sort of break us out of this volatility that we're in right now?
I think it's all about the Fed. So once we get clarity from the Fed that the rate hike cycle is over, and we have more of a sense of the rate cuts coming in 2024, that to me will mark a very significant shift for markets where investors can become more risk on, where we're likely to see yields start to fall.
Certainly a lot to keep track of. Appreciate you at least giving us some clarity and breaking it down for us. Kristina Hooper, Invesco Chief Global Market Strategist. Good to have you on. Have a great weekend.
You too. Thank you.